multilateral development banks invest billions to drive equality, sustainability, and climate resilience worldwide. And every year, it's not enough. The global financing gap is massive. Progress on the Sustainable Development Goals is stalling, not for lack of effort, but for lack of affordable capital. Meanwhile, pressure is mounting. Climate shocks, debt crisis, crumbling infrastructure. MDBs are stepping up, innovating, mobilizing, and maximizing resources. The OPEC fund is likewise adopting smart financial tools. A new exposure exchange agreement with the Inter-American Development Bank reduces risk and boosts lending power. Our first sustainability-linked loan, tied to ESG targets, supports food security and rural livelihoods across sub-Saharan Africa. Part of a $394 million syndicated deal with 6 partners, it shows how performance-based finance can attract more capital while keeping sustainability front and center. These aren't one-off innovations. They're part of a shift towards smarter, more coordinated, more catalytic finance. A shift designed to close the gap and finance the future.
So much to all of our delegates who have joined us this afternoon, because I know that this was one topic that seemed to be oversubscribed. This morning, people kept coming into this auditorium saying, are we talking financing yet? Are we talking financing yet? Well, we're doing it now, funding the future. Obviously, with cuts in overseas development assistance, a lot of developing nations that are managing debts and high debt servicing costs, growing demands for climate financing alongside education, infrastructure, health care. Money is spoken for, but we are short of money. So how do we create value with limited resources? We understand the problems, but what are the financial innovations and the solutions? That's really what we're talking about in this session, as well as embedding the role of the multilateral development banks into that solution about funding for the future aspirations that we have. So delivering some remarks to really start focusing our minds on this topic of funding the future, I'm really happy to invite onto stage Tariq Sherlala, the Vice President for Finance at the OPEC Fund for International Development, to set the tone.
Thank you, Lorato. Good afternoon, everyone. It's a real pleasure to open this panel discussion along distinguished peers from colleagues from peer institutions, as well as our partner country, China. We gather here at the moment of profound global challenge, but also extraordinary opportunity. The past few years have tested the resilience of our financial architecture. The COVID-19 pandemic did not just disrupt lives and communities, it brought to sharper focus old vulnerabilities and inequities. Today, over 800 million people live in extreme poverty. Low-income countries are grappling with high debt burden that threatens to do away with recent hard-won development gains. But if the pandemic exposed weaknesses, it also helped galvanize new thinking in the development community. It demonstrated cooperation and a growing determination to do things differently. MDBs are not just critical sources of financing, important as that is, but have become platforms for innovation, partnership, and impact. Together, we're proving that with the right reforms, tools, we can be smarter and faster. One such example is the groundbreaking independent review of MDB's Capital Adequacy Framework, CAF, an initiative launched under the Italian presidency, the G20 presidency in 2021. Its core message was simple but powerful. by enhancing outdated frameworks, optimizing balance sheets, embracing new tools of financial instruments, MDBs could unlock hundreds of billions of dollars in lending without compromising our financial integrity. Since those recommendations were endorsed in Bali, the results have been promising. First, capital adequacy framework reforms are expected to generate between $300 and $400 billion in new lending over the next decade. Second, the use of risk-sharing tools like hybrid capital and guarantees will unleash both shareholder and private investment. Third, and perhaps most importantly, we're seeing unprecedented collaboration across NDBs at the country level through initiatives like the collaborative co-financing portal. Although we are smaller in size, the OPEC fund, we have been stepping up, providing more assistance because we recognize the urgent needs of our partner countries. We have dedicated resources for concessional lending, diversified our funding sources by tapping capital markets, and significantly invested in our capacity to deliver projects. We have also adopted and applied high-quality accredited ESG standards and set up development effectiveness framework to help us measure and report results, outcomes, and impact. All of it just mentioned speaks to the power of collective action and shared innovation. But we know the work is far from done given the challenges ahead. The CAF report and the G20 recommendations have given us a map and the momentum to work together. We are really putting them into practice. As an example, the OPEC fund partnered, as mentioned earlier, with IDB on a pioneering exposure exchange agreement, the first of its kind between a AAA and non-AAA MDB. This helped us both to reduce concentration risk and increase lending capacity. This is just one example of what we will hear from the distinguished colleagues and speakers in the next panel of the innovative solution they are already adopting. Ladies and gentlemen, the outcomes of this panel are crucial to reverse the recent trend in the increase in the number of people living in extreme poverty. Together, we must close the widening HDD gap, now estimated at $4 trillion. Let us seize this moment to build a system that is faster, smarter, and truly fit for the future. Thank you very much.
Thank you very much. Thank you, Tariq Sherlala, Vice President, Finance at the OPEC Fund for International Development. So our Q&A now and panel is going to be moderated by Jacob Young from Signum Capital. And as you come up, Jacob, please may I also invite your panelists to join you. Thank you.
As you wish. Good afternoon. I hope you are enjoying the splendid backdrop of the Hofburg to address these important global questions as much as I have. Today, we are answering the big question: how to pay for the infrastructure, the education, the climate change adaptation in a context of compressed global ODA envelopes and debt sustainability pressures globally. As Tariq outlined, there's hope, and that's what we want to share on the panel today. Global development finance institutions and governments are coming together with new ideas, new tools, and new partnerships. I can't think of a better panel to talk about this than what we have today. To go through their strategies, their policy actions, and their collaboration in response to the G20 calls for capital adequacy review and unlocking new capital. To my left, we have Soren Albeck, the Chief Risk Officer of the Inter-American Development Bank, Asetu Nsele, Vice President and Chief Financial Officer, African Development Bank, Monale Ratsoma, Vice President and Chief Financial Officer of the New Development Bank, Andrew Cross, Chief Financial Officer, Asian Infrastructure Investment Bank, and Yang Xiaolin, Director General, Ministry of Finance of People's Republic of China. Perhaps I'll begin the first question addressed to you, Andrew. As one of the newest, most capitalized multilateral development bank, what is your involvement in the CAF review, and what innovations are you bringing to the global community?
So thank you. I tried to avoid the first question, as you saw, by moving down, but Jacob's too smart for me. But first, can I thank Tariq and the OPEC Fund for the invitation to be here. I can't speak on behalf of the panelists, but I think you'll get the impression that we take these opportunities very seriously, and the OPEC Fund creates a venue for us to have this conversation. So the point is very valid. So like my peers, AAA ratings, heavily capitalized balance sheet, AIB is 10 years old, so in a different part of its evolution to some of the other MDBs that we're part of the community with. In fact, we have our annual general meeting celebrating 10 years next week. So in some ways you could say we could be very observant on the G20 CAF reforms, whereas the institution has been very involved. In fact, we partnered with African Development Bank on a guarantee product in the panda market, which is the first time that's been done. It's an illustration of the innovation that's required. We did $1 billion, essentially, risk transfer with the World Bank, where we took $1 billion of their assets off their balance sheet. That was beneficial for AIIB because it allowed us to increase the diversification, increase the balance sheet. And these are very illustrative of how the community can work together. I'd say it won't surprise you as the CFO, though, that what sits at the bedrock for me, and I believe the institution and our 110 shareholders, is financial sustainability. So quite rightly, both in the opening session of the fund and in this session in the video, the challenges we know are absolutely extraordinary. And I'm pretty sure you could justify 5 trillion, 10 trillion, 15 trillion, depending on what the challenges that you are focused on, whether it's climate, whether it's SDGs, whether it's infra. What that fundamentally tells you is that within the MDB community, individually and collectively, none of us have the balance sheet to be able to take that challenge on. Collectively, we can, but individually we can't. And without the involvement in the private sector, which I just think is common sense, unless we have the involvement in the private sector, we in no way can reach the challenge. But if I return to the point of financial sustainability, MDBs are effective because they have AAA ratings, because they are financially independent and sustainable. And essentially, if you look at the model, reinvesting profits, reinvesting surplus, reinvesting retained earnings in the equity base of the MDBs allows them to do more. Without financial sustainability in the MDB community, we're not going to be able to achieve those challenges. So for me, in the role that I have, I'm very acutely sensitive to keeping the institution very focused on its mission, not having mission creep, being very focused on what we do, which means that sometimes as an institution you have to make difficult choices and accept there are things that you can't do, whilst accepting there are other institutions better positioned. So financial sustainability combined with the innovation has been the AIB's approach to the CAF G20 reforms.
Thank you. Maybe I'll bring in Soren now, just for the contrast of an institution with an extensive track record, and what has been IDB's response to the CAF review?
Thank you. And at first, I echo Andrew's comments about thanking OPEC Fund for bringing us together here today, and to Jacob for bringing the panel together and for moderating. So, indeed, the CAF report was catalytical in the sense of bringing together the MDBs as a system to work together more cohesively. Innovations have been a part of what MDBs do for quite some time. It has already been mentioned a couple of times here today, the exposure exchange agreements that are being done between the MDBs, and they actually have 10 years can celebrate 10-year anniversary also this year. So very importantly, it was original between the IDB, African Development Bank, and the World Bank, and then has been now expanded to also include the Asian Development Bank. We very proudly last year signed with OPEC Fund an exposure exchange agreement, as mentioned, and then only a few weeks ago, we at the IDB signed another one with the Council of Europe Development Bank. So clearly, it is an ongoing instrument that keeps evolving, and we also heard this morning about the exposure exchange agreement between the CABE and CAF and the Caribbean Development Bank. So clearly, it is very good that this innovation keeps moving on in order to mobilize more capital. In addition, I think it's important, we at IDB have also been looking at getting shareholder guarantees on our exposures. So, for instance, with the Swedish government, we are partnered to get some of our loans basically transferred to risk on Sweden, so where we take development exposure on countries that are not AAA rated. I mean, that's our mission. Through this guarantee from a AAA rated country, we can then free up capital, which then allows us to basically recycle that capital into projects that, for instance, are important to such a shareholder. We have also innovated private insurance on our loan portfolio. We have engaged with a panel of originally 14, now 18 private insurance companies, where they basically bid to guarantee for loans that we put up on a platform, allowing these private insurers to then basically take exposure to the loans, the performing loans that we do, and then in essence we then exchange exposure on these loans for exposure on private insurance companies, again freeing up capital that allows us to build more lending capacity and again recycle capital to meet the demands of the region we're there to serve. With MIGA, which is the World Bank's guarantee arm, we are currently working on an innovation that allows MIGA to guarantee a single loan in Brazil, in Sao Paulo, that we're working on, 350 million, which is a pilot program for MIGA that hopefully will then allow MIGA to develop a broader product that can also help MIGA guarantee MDB portfolios, again with the purpose, of course, creating more lending capacity as a system. And I've said this a couple of times, and I want to mention it also here, that we as a system have also much more started coordinating between us, thinking of, we have created a called the Global Risk and Finance Forum, the GRAF, which now meets regularly to exactly align around common objectives and develop ideas that we can then pilot and implement together and hopefully, of course, scale. I mean, ultimately, of course, the whole key is to be able to scale massively so we can meet these challenging. We are undertaking benchmarking across the MDBs that will allow us to also understand better what is AIB doing, or African or NDB doing, that we at the IDB can learn from, and of course, if we can do much more in terms of scaling, would be tremendous to close the gap. I think Andrew already alluded to it. I mean, we can't outspend the global challenges, but we can out-leverage them if we work together as a system, and I think that's what we are aiming to do all the time. Thank you.
Thank you. Next, we'll turn to you, Manale. And certainly, NDB was founded on the principle of South-South cooperation. We'd love to hear more. What does that mean in operational impact in the context of what has happened since your founding and the CAF review and the push to do more and more sustainably?
Thanks very much, Jacob. I think, like the AIB, we are attaining 10 years old this year. We're celebrating with our annual meetings a week and a half from now. Our story has also been very interesting. Over the last 10 years, I think you can take maybe the first 5 years of operation is just setting up the plumbing. And we were hit, as Tariq said, by COVID. It meant that we had to be very adaptable in the way that we operate. I think we were one of the first few MDBs to respond with health-related emergency loans. We followed them up with economic recovery loans. I think we had a total package of about $10 billion that we made available to members. But what has also set us somewhat apart in those years of operation is that we lean a lot on the use of country systems. And it's something that is quite particularly different to how the other MDBs have operated. And I want to illuminate this with an example of what that means in real life, right? And use an example of South Africa and how South Africa, with its own history, has used tools like procurement as part of its redress. So these are very much entrenched in procurement processes. So in historical cases, you find that maybe other institutions struggle to penetrate doing financing in countries because they tend then to impose on how countries must do either procurement or must approach environmental and social standards and so forth. So in our case, we then tend to assume a lot that I think the country has got in place its own systems, and of course it will have to test it against certain principles, i.e. that the procurement processes have to be transparent, have to follow very competitive processes and so forth. So in the case of South Africa, procurement is quite key. It's quite key because, as I say, it's part of a big tool in terms of doing redress for historical inequalities and so forth. So we've been able to come through into countries where we do business on the basis of seamlessness in being able to connect with how countries do on procurement. And the other bit that we've been trying to define as our niche is in our approach to local currency. We have been much more stronger in our approach to local currency, much more deliberate in that we come in as well to issue in local currency to facilitate our lending in local currency. I think our members have been quite clear and explicit in that they prefer to use of local currency in the way that we finance our project. And this is not an anti-dollar semantic. It's just from their own avoidance of hard currency risk. We've been very successful in panda bond space. I think we are the largest issuer in the panda bond space. But we use that as part of the reform process in these countries. So we go in and we look at the different regulations and policy requirements, and we try to seek those that we feel that are obstacles to institutions like ourselves in creating scales in how we can operate. I mean, in the panda bond space, for instance, we've got 100% convertibility of our proceeds. So we're able to issue panda bond and convert it completely into USD. In many instances, we're able to come inside where we would be issuing our dollar issuance. If we would have done SOFR plus 80 basis points in our dollar issuance, coming through the panda bond space, we're able to convert that, and we arrive at, in some instances, SOFR minus outcomes. So also have sought exemptions. We've been granted at least to have our proceeds being able to be placed as collateral, full collateral for the repo market. So that has also helped in creating scale in how we use the panda bond space. So we follow the same processes in South Africa. We've got a program in South Africa. We are being deemed as registered as a domestic issuer. The importance of that is that investors that invest in our bonds in South Africa are not going to be subjected to limits on foreign investment. So they are classified as a local asset. We've been granted a few more exemptions there. We've just recently come from India, where we're looking at a similar approach. We were seeking specific exemptions that are going to help us increase our investability of our bonds. So we're trying a different number of things to ensure that we improve our investability in our local currency. On the CAF work, as I say, the last few years, I think, out of the geopolitics, we probably have been the one that has been hardest hit. It is constrained in the way that we could do business with other MDBs, but we've been in conversations on explosive exchange agreement and so forth. hybrids. We've been exploring those, but the traction has not been as fast as others have enjoyed. So what we're trying and testing now, Jacob, is to an extent to which we can use, because we are in a process of expansion of membership. We have a number of countries that are at different stages of becoming members of the bank. That means that they are still going to pay in capital, be it maybe a profile of 3 years, 5 years, but we're trying to test if we can bring all of that paid in capital forward. So we can package an instrument that is subordinated capital, sell it to maybe some of our strong shareholders, and then use the paid in capital to create like a coupon arrangement where we can front load all the proceeds of the paid in capital and bring it forward. And so this will rank almost higher than equity, but somewhat lower than unsubordinated debt. And in the way that rating agencies have classified some of this instrument, we feel that in the conversation we should be able to get the benefit of that as equity. So we're trying different things in an environment where it has not always been seamless for the NDB to operate. And I can say, in parting on this point, that we've been able to achieve an approval book of about 40 billion over the last 5 years. Within these very challenges that I have posed, to build a balance sheet close to 33 billion in the context of all of this. So there's many more things that we can share that we think that the bank, despite some of these constraints that have been imposed, has been able to proceed forth.
Great. On the topic of hybrid capital, perhaps I'll turn to Hassa too. And given the African Development Bank has been on the forefront of some very innovative transactions, obviously the hybrid capital transaction last year, but much earlier, Room to Run, there have been many examples. What's next?
Many things, but I thank you very much for having the African Development Bank as part of this conversation. And I really like the theme, empowering our future. At the African Development Bank, using financial innovation in order to increase development impact is not a luxury, it is a necessity. Because basically the amount of capital that we have available from traditional sources is not sufficient to meet the needs of the African continent. And this is why we made a very deliberate choice to use financial innovation as a strategic lever to increase our lending capacity, but also our development impact. So it's been about, we've been driven by innovation, by vision, by necessity, and by the mandate of the institution. So, you've talked about hybrid capital. The thing is, the bank is not just about lending, it's about how do we mobilize others, being the private sector, being even the public sector at scale, to look at the African continent for its development. So, you talked about the exposure exchange, and congratulations, on the EEA between the IDB and the OPEC fund. It's the first between the AAA and the non-AAA. We were part of the first transaction with the World Bank and the IDB, and here it was very simple. We could no longer lend to North Africa, one of our very large clients, and we needed to have a solutions. And the EEA, structuring the EEA was the solution. We've been evolving the balance sheet of the African Development Bank since 2015. EEA, we've looked at, you talked about the synthetic securitization, a pioneering initiative where basically we had private sector investors from outside of Africa that had never been exposed to African risk, taken exposure on the African Development Bank, and also African investors. It was a success because those investors are knocking on our doors again. They wanted to do a new transaction. We just didn't have enough assets to synthetic securitize with them at the time. Very good, and there is that the perception of very high risk in Africa, but here we had a demonstration effect. Despite COVID, despite all the turmoil that Africa had to go through, that portfolio had zero loss. So they are willing to come, and even at a better pricing. So this is the type of role that we play. Hybrid capital, and Jacob, you were part of that story. It is something that took us 3 years to do. We worked with Goldman Sachs and other investment banks, and we did a very successful transaction last year, $750 million, allowing us to do $2 to $3 billion in additional resources. So hybrid capital over time for the African Development Bank has the capacity capacity to unlock $14 to $18 billion at affordable price. And here, I mean, the hybrid capital solution that we designed was for both sovereign and the private sector. We started with the private sector. So basically, you can think of hybrid capital mobilizing the private sector at scale for development. And it's something that let me put it this way, and there is you've heard about the origin, I'm sure you're going to talk about the originate to share, but if you look at synthetic securitization, we were a lend and share type of institution, but this is exactly what we need to do. Our capital needs to be able to unlock. It needs to be able to work for development. So what is next? So before I go to what is next, the G20 CAF was really something that we appreciated because many of the things that we had done were part of the report. So what is next? So right now we're working on a multi-originator synthetic securitization platform where we're not just taking the private sector portfolio of the African Development Bank, but we're looking also at African DFIs. And why not DFIs, MDBs outside of Africa? So this is the next step for us. We do have guarantees, and the VP Sherlala was talking about guarantees. So the guarantees that we're doing have evolved. So you will see, okay, AFDB partial credit guarantee, but it's a product that has been adapted, and I wish we had some kind of trademark or where people can pay us, because some of the banks have been replicating and proposing to other countries the structure that we've been able to come with. But at the end of the day, we are MDBs, and our role is development. We are not competitors. We need to work together because this is the only way that we can attain full development. When we put all our minds together, work towards the same goal, that's where you're going to see the most impact. And that's one of the very good outcomes of G20. Soren was telling you about the graph, where all of us are speaking together and laying out ideas and seeing how we can move together.
Very, very well said. Very well said. Thank you, Asatu. Now, if we may turn to you, Yang Xiaolin, we'd love to hear, in a two-part question, from a country perspective, an important country in the global system. What do you think are the challenges, the main challenges in the multilateral system that we need to address? And the second part, of course, will be the solutions.
Okay, thank you. As other panel members, I would like to thank OPEC Fund for organizing this important event. As you just said, I would provide a different perspective from the MDB's colleagues who are just talking. For us, I fully appreciate the innovations and the enthusiasm of all the MDBs working together, try to find new and innovative ways to helping our clients. But the global landscape of official development finance are really changing since late 80s to early 90s until now. The relative importance of official development finance actually is decreasing because there are more partners, more players in this field. So we have to be realistic when we're talking about how much MDBs can do to help our countries in need. And plus, at this moment, we all see the headwinds of globalization, right? The uncertainty created by the unilateralism, created by the trade protectionism, which really gave us a lot of challenges for the global cooperation. So for that part, I would like to just offer a little bit of our side of the understanding of the challenges for countries that need to be helped. Of course, the first thing is the gap, the financing gap. Many of my peers already talk about that. And in the morning, we heard one of the keynote speakers saying, IMF estimated the core financing gap for the SDGs is about 3.5 trillion. And overall, we all know it's more than 4 trillion needs. Where the money come from? Secondly, the debt crisis. We have to be honest. This is one of the the biggest challenges for many of the developing countries we're trying to help. Currently, more than 3 billion population in about, many countries, the repayment is higher than the investment in healthcare and education. In more than 50 countries, debt servicing consumed over 10% of all government revenues, and probably even 17, if I got it correctly, countries reaches 1/5 of their government revenue just to pay the debt they have. So we have to make sure there's a ways of addressing this, the borrowing cost, and also help them in the meantime to put them on the sustainable path of development. So that's the debt. Thirdly, the demand are going up. Unfortunately, the resources are going down. From the traditional donors, we all know that they are already facing domestic challenges and budgetary constraints. So the bilateral official development assistance is going down, and the donor countries' contribution to the MDBs is also on the downward trend. So these are really the concerns for the global community. How can we work together? It's not only just for the public sector, the governments. We have to also work with the private sector, with the other the players in the field, be it philanthropy, the non-profit organization, and so forth. So we need to work with them to find the ways. We heard that innovative ways of trying to mobilize the resources, but the real issue is, could we find new and additional resources? Fourthly, on the green and the sustainable financing, again, a huge gap. How can we do that? And for the developing countries per se, the biggest issue is, of course, financing is critical, but the access to viable resources is also very important. How can we guarantee that through viable means? And also the technology is necessary for them to implement the renewable strategy. How can we help them to find those technologies, or to get the other part of the equation to work together to help them? Lastly, but not least, the geopolitics, uncertainties, and trade conflicts, as I just mentioned, cause a lot of problems and disturbance in the development field. So we need to, at this moment, to fully commit it to the multilateralism, to work together, uphold the principle of WTO rules. We have to protect the stability of the global production chain and the supply chain. It's all very important for developing countries. So we have to work in a holistic way of addressing all the challenges. So you give me the chance to also answer what we see the solutions for these problems. We all know that the SDGs requires tremendous amount of joint efforts by everyone. And by the just concluded UN ECOSOC meeting, Secretary General Guterres called for a joint global efforts to reducing the costs of financial resource mobilization for developing countries, to help them to stem out the liquidity and solvency challenges. And by the end of this month, we're going to have the 4th UN conference on financing for development in Spain. I think that will be a good place for all the players join that forum to explore the ways to find the solutions. Of course, today here, OPEC Fund provides us with this opportunity to discuss ways of innovating solutions. So for me, if I may, I would like to suggest a few things. First, we need to leverage development finance at its scale, as well as at reasonable cost for developing countries. As I said, public, private need to work together. And also the multilaterals and the bilateral agencies need to work together. I'm very happy to hear many of the agencies here, they're already doing that. Just to give you a little bit of update on what China is doing. China has just made $1.5 billion US dollar equivalent contribution to the IDA 21, the concessional window of the World Bank Group, which represent 26.8% increase of our contribution for this round. And China also contribute another $138 million US dollars to the Asian Development Bank financing, concessional financing window, which also represent another 15% of increase for our contribution for that particular institution. And I'm very happy to see, and I also heard from both the AIIB and the NDB colleagues, they are the new kids on the block. They are actually up and running. We're so happy to hear that AIIB already, by the 10 years they're crossing that mark, they already financed more than 60 billion US dollars to member countries. And NDB, we just heard from our colleague, another 40 billion, which is a great addition to the existing multilateral system. And for China, we're working together with the multilateral agencies, both the traditional one and the new ones. In particular, I want to mention that there's a multilateral cooperation center for development finance, which is housed in the AIIB. And jointly, China with Egypt, with Saudi, and 4 other members contributed more than 180 million US dollars just for the purpose of preparing projects for all the MDBs and even bilateral agencies, helping them to create capacity and also transfer knowledges. These are the efforts I think is very good and helping us to fill up the gaps and also mobilize all the bilateral and the multilateral agencies together. The second issue I want to mention is that the efforts on reforming the global financial architecture, which is important. You all mentioned the G20 CAF proposal, but one of the key issues for all the MDBs is the reform of their internal governments. The governance structure need to reflect the 21st century economic landscape, which means it needs to give more voice of the developing and emerging economies. And the MDBs need to improve their internal governance, streamlining their capital frameworks, innovating financial approaches, strengthening lending capacity, and also mobilize more financial and intellectual resources, which are critical. So in this field, we would really like to see all the MDBs become stronger, better, and more effective. Not just the World Bank, as mentioned by some colleague in the morning. Certainly, definitely for the green and sustainable development, we see a huge gap. Here, we would like to urge the developed countries to honor their commitments, and we should follow the principle of common but differentiated responsibilities. But the most important thing, as I mentioned before, is the access to viable resources. We have to help our developing countries to have those access and make sure they are on a sustainable basis. For in this sense, financing and technology are critical. We have to help them. For China, we have been working with the South-South partners. We created this South-South Cooperation Fund, working with 20 multinational agencies in 60 countries for currently 160 projects, benefiting more than 30 million residents in those program countries. And we are also encouraging multilateral and bilateral collaborations. Currently, we're working with the AIIB and the French AFD to collaborate with China's policy banks to promote and trailblazing new ways of financing in Africa, in Asia, and other regions. So we hope this will help and improve the collaboration in that field. And for the importance of the debt issue, I already mentioned that the multilateral and the bilateral creditors, as well as the commercial lenders, they should work together to address the issue. So global challenges require global action. So everybody should participate and find a fair and equitable solutions for our development. Lastly, I just want to mention that I want to fully echo the comments made by the President Khalifa in the morning. All the programs, whatever we do, be it multilateral or bilateral, it has to be country-driven. All the programs need to be indigenized, catering to the specific country needs. Otherwise, you just pass on the good practices, it won't help. So we really want everybody to keep in mind, when you're trying to do your project in the countries, do work with all the stakeholders and really treat the realities on the ground seriously. And I wish you all the success. Thank you very much.
Thank you. Perhaps given the few minutes we have left, there'll be a closing ceremony, which I hope you all will attend. I'll move to perhaps a quick fire style of question. Ultimately, many of you have mentioned the importance of collaboration, of partnership, and certainly 10 years ago, I don't think there would be as much to say if we had the same group of distinguished guests on this table. A lot has already happened. Maybe as a quick fire, what more can happen to increase the collaboration across development finance institutions? If there are no volunteers, I'll point to Andrew because the AIB is very proud of its collaboration and its first decade of growth. But I'd love, and this is a quick fire, so as few words as you can. What more can be done to increase collaboration in the sector?
So if I actually pick up Hasatu and Soren's comments, I mean, we're a world awash with acronyms. So, and we've just introduced a new one, which is GRAPH. So you could say, if you measure us based on the number of acronyms we're adding to the debate, we're doing really well, but that's very flippant. I think that the benefit is that when you have an organization which has a clear terms of reference, a clear structure, clear schedule, you force organizations to commit to delivery. Every panelist here has talked about development and outcomes. All of us are singularly focused on outcomes. As a practitioner, from where I sit, vision is obviously vital. Goals are really important. Implementation is where the magic happens. That, to me, is the absolute hardest part. We have 700 people, other institutions have more, some have less. So being measured on your developmental outcomes, absolutely vital, because then that tells you how you're using the resources. So these structures, although they're sort of the governance infrastructure that sits behind everything we do, they're absolutely vital for bringing the community together, because I think, as has been outlined, we can't solve it individually. It is enormous. We're going to have to do it collectively, and it is going to require DFIs, IFIs, bilaterals, MDBs, the entire global audience to tackle these issues.
Thank you. And maybe next I'll turn to our only CRO on the panel to talk about risk evolution and the collaboration that IDB's fostered, as well as interaction with rating agencies. If there's a few final words that you could.
Yeah, that's what I wanted to mention, is we should certainly not forget that our ability to move and mobilize capital and of course borrow money from capital markets is very much dependent upon a clear collaboration with and understanding by the credit rating agencies of the realities that we operate within. And we have done a lot as a system also in that regard. We have started publishing our default and recovery statistics that allows rating agencies and investors, and of course also among ourselves, to better understand what is the actual reality of these preferred creditor treatments that we are all benefiting from as we the way we are set up. Better recognition of how the callable capital portion of our capital structure functions. Some of us have started including that in our own capital adequacy metrics, and of course, again, through collaboration with rating agencies to get a better understanding of that. African Development Bank has pioneered hybrid capital as a part of the capital structure, again getting recognition from rating agencies as to how that works. I think the broad understanding of for instance, insurance products, risk transfers that are being done in the MDB sector is super important for us to continue creating headroom in the balance sheet. So I think very important to mention that this collaboration rating agencies is important. We also, as a group, have started meeting with rating agencies and roundtable discussions every 6 months. Getting rating agencies together with all the MDBs in one room has also, I think, increased understanding of the nature of concentration, which we all suffer from or are faced with, right? IDB can only lend in Latin America, so therefore the exposure exchange agreements have been very important, but also the metrics by which rating agencies look at this concentration is something we have started tackling with them, and we are very happy to see that, for instance, S&P has started now opening up its methodology for allowing concentration risk to be something much better understood through this, provided more data, more collaboration, and more communication from rating agencies and with rating agencies about how we function as a individually and collectively as a system. Thank you.
Next, we'll turn to you, Manal, and I'd love you to bring in NDB's membership expansion into this discussion as well, which is obviously a distinguishing and interesting development for the global system.
Yeah, thanks, Jacob. I'll get to that, but I think I want to challenge my colleagues, especially on the subject of local currency, to try and be a little bit more aggressive than they have been in the past. I think I've already pointed to various areas of specific reforms that can be pursued with local regulators that can open up the market a little bit more. And I think that could be, as has been issued as a challenge, where MDBs can collaborate a little bit more. As an example, I mean, we use, so we have an exemption to be able to use our CNY proceeds beyond just China. I mean, we've got projects in Bangladesh that enjoy CNY, we've got projects in Brazil, a number of other member countries of NDB are exploring using CNY, just given that in some of the projects they will have exposure in some of the import of material. We're seeing the same approach coming through out of India as well to try and internationalize the INR. For the region, I think there could be a benefit for that. In South Africa, we'll pursue the very same, that member countries or neighboring countries, South Africa could possibly enjoy the use of ZAR, but much of that is really constrained in the regulation. So we pursue these regulatory reforms. I think as a group, I think we stand better chance of seeing some of these reforms taking place. I think it also helps to improve just the capacity of those local currency markets. I think on our membership journey, I think we're taking it each step at a time as an institution, only because as we are well aware that we don't have some of the AAA countries amongst our midst. So therefore, as we take in members at first priority, we have to ensure that our credit rating is preserved. Ultimately, yes, the end goal is that we want to have much more diversified portfolio. Yes, the rating agencies point to that, but at the same time, we want to have a diversified but strong rated portfolio. So hence, we're so slow in our approach. So we're taking, obviously, time to look at countries and their strength and the extent to which they're going to contribute positively to our credit rating. So this is the journey. We've got a long list of countries that are looking to become members. We are also thirsty to have our capital base grow, And as I was just indicating earlier on, what are we exploring in bringing some of the patent capital forward so that we can improve the extent to which we're able to lend. I think it's likely to be quite a very gradual, long journey ahead.
Perfect. And finally, Asitu.
Thank you. I think, Hello. Yeah, I think that the same way that the G20 have asked MDBs to be bigger, bolder, and more effective, I think that partner countries need to embrace innovation. They're extremely conservative. So there are limits to innovation by MDBs themselves, and we need to bring it to the next level. So partner countries need to embrace innovation, be risk participants alongside MDBs in order to have scale. And sometimes I've seen, when I look at hybrid capital, when I looked at SDRs, it takes sometimes as much time to structure, conceive a financial solution than it takes to convince your senior management, the board of directors, the stakeholders with regards to that innovation. And two things before I end. So one is to address, I think that for Africa at least, domestic resource mobilization, local currency capital markets are the way to go. Today, the US doesn't fund themselves in euro and vice versa. They fund themselves in their own, all developed countries fund themselves first in their own market. Ours are too thin, there is no depth, and basically countries have to go into the euro market, to dollar market, expose themselves to FX risk and what have you. So that should be a priority. When I started in the industry 20 years ago, it was, oh yes, local currency, but it's, it's a long-term project. And everybody's talking today about, we need to mobilize the private sector at scale, oh, but we need to hedge FX solution, etc. That's short-term. The solution, you develop the local financial markets of African countries, and I think that this is where we can collaborate because some of us have strengths in there. But that was just, so another thing that I want to talk about, and I will always talk about that, is the channeling of SDR through multilateral development banks. The same way that the IMF, channeled $650 billion to the whole countries in the world, Africa receiving 5.5%, the 54 countries of Africa receiving less than the US or less than Germany or less than Japan, is a wake-up call. So and we've been partnering with the IDB, and our solution basically states that today, if a country takes its reserves and lends them, not donate, but lends them to an MDB, AAA-rated MDB, many things can happen. So first, we can leverage it 4 to 8 times with co-financing. So basically, a country lends $1 billion to an MDB, we can lend $4 to $8 billion for development. What does it cost to the country that is lending? Nothing. So zero cost to taxpayers, no impact on the budget, but even more, basically they can still continue to account for it as being part of their reserves, as indicated by the IMF. So here, we're grappling, we're talking about ODA that is going down, issues with regards to resources. Here is a solution that countries need to embrace. We're very thankful to Japan and to France for their leadership. And it's going to take time, but just imagine a world where 100 billion, the same way that the IMF, issue their SDR, 100 billion to MDBs, basically this group and other, $100 billion is $1 trillion that we can put like that easily for development. So let me end with this thought.
Thank you very much. We've overrun our time, but I want to thank all of you and to thank our panelists in particular. I think we could have gone on even longer, but this was very fascinating. Thank you so much.